Hi, everyone. So welcome to the stream today. Very much excited for having you once again on the stream. I believe that you are doing well. And today we want to continue with our discussion and we want to look at some questions in financial reporting, answer a couple of questions concerning the standards in relation to that. So if you join the stream, comment in the chat box with all of your questions that you have for me. What standards would you want us to cover, or anything that you have questions on? You can put it in the chat box. I'm going to be reading your comments and answer all of them. And give us a like on the button. John Edu, so we are in. All right, John, you are welcome. I believe you are doing well. Give me a thumbs up on the video and let me know if our sound is okay and everything is fine. Okay. So we are continuing with the Executive Revision Masterclass, trying to answer questions and focus on some key areas for the exams. And I believe that it's been going well so far with everybody here. So comment in the chat box. Today we're looking at financial reporting, corporate reporting, and I'm focusing on the accounting standards. We're going to be solving a couple of questions real quick. Hi, everyone. So welcome to the stream today. Very much excited for having you once again on the stream. I believe that you are doing well. And today we want to continue. Right, so let's get into our discussion real quick for today. All right, Kledos, I see you. I believe you are doing well. So give us a thumbs up on the video. We're looking at a couple of questions today, and I'm going to be answering your questions for you as well in relation to that. Hello? Hello? Okay. Is my sound okay? Let me know. Is my sound okay? It appears my sound is breaking and clinging a little bit. Let me know if my sound is okay in the comment box, in the chat box. Can everybody hear me well? All right, so we've discussed a couple of issues about the accounting standards. We've discussed some of the standards in relation to IAS 16. IAS 36, IAS 38. And today what I want us to do is to look at a couple of questions still on the standards for you to know how to do a couple of treatments in relation to that. Then you comment in the chat box as well what standards you would want me to also share my thoughts on. And then if you have any questions also relating to corporate reporting, financial reporting, you can put it in the chat box. I'll be reading all and I'll be replying to all of them in relation to that. So going straight up to our discussion, we're going to be looking at a couple of questions today. The first one we want to look at is a question relating to, Ebenezer, I see you with a thumbs up in the chat. Thank you. Okay, Cletus said the sound is good. All right, thank you. So we want to look at a couple of questions today on the accounting standards and remind ourselves of a number of principles and how to do the various treatments in relation to that. So we're going to be looking at some questions around IAS 37, IAS 16, IAS 20, government grants, and then we're going to also look at some questions under IAS 23, borrowing cost in relation to that. It's my desire that through these questions, we will be able to address a couple of weaknesses and challenges that we are having in the understanding of some of these accounting standards in relation to that. So the first one we want to look at is a question on IAS 37, IAS 16 in relation to that. So let's see how it goes. You can take a screenshot of the question. I'm going to be explaining it then. I switch over with my dashboard, then we go through it. So on 1st October 2015, Promoil acquired a newly constructed oil platform at a cost of 30 million, together with the right to extract oil from an offshore oil field under a government license. The value of the terms of the license are that Promoil will have to remove the platform, which will then have no value, and restore the seabed to an environmentally satisfactory condition in 10 years' time, when the oil reserves have been exhausted. The estimated cost of this on 30th September 2025 will be $15 million. The present value of $1 receivable in 10 years' time at the appropriate discount rate for Promoil of 8% is $0.46. So this is the question that we have. As you can see, it's an IAS 16 question and an IAS 37 question in relation to that. Now, how do we know there is an IAS 37 in here? Because of the restoration cost. Remember when we were doing IAS 16, we said the component of the initial cost of an asset will be the purchases cost and all other direct costs incurred in bringing the asset to its present use, including the present value of restoration or dismantling of the asset, right? So that is what we're going to be looking at. Once we read a question, we will be able to know, or we should be able to know that this is what we are looking at in relation to that. So what is the requirement of the question? It says, explain and quantify how the oil platform would be treated in the financial statement of Promoil for the year ended 30th September 2016. So the year starts, let me pick my highlighter so we could bring some figures up. So the beginning of the year is 1st October 2015, and the year ended is 30th September 2016. So that is exactly a year, right? So let's get some preamble. Again, the cost of the platform is $30 million. And we are told that the estimated cost of the dismantling is $15 million. Remember that as always, when we are dealing with the issue about dismantling, we have to discount it into present term. You know that, right? And we are told that it is 10 years time, meaning the economic useful life of this newly constructed oil platform is 10 years. And when we are discounting also, we're going to be looking at 10 years in relation to that. Then we are giving the annuity of $1 in 10 years time to be $0.46 in relation to that. Chachu Seketosis, I see you. You are welcome. Thank you for the thumbs up in the chat. Give us a thumbs up on the video page as well. That way it gets more engagement and the video will be able to be pushed by YouTube to others to watch in relation to that. So how do we go about solving this question? Now, you can take a screenshot. The key things we need are, one, the cost of the asset, $30 million. We're going to be picking that up. Then we need the restoration, $15 million. And then we are told that $1 in 10 years time is 0.46. So if we want to get the present value of the $50 million, we multiply the $50 million at what? 0.46. So that will give us the present value of the replacement cost in relation to that. Then the double entry for the replacement or the restoration is that we debit PPE and then we credit what? Provisions. So the initial recognition of the provision is to debit PPE and then we'll credit the provisions account. Then on subsequent measurements, the asset will be depreciated using the economic useful life. In this case, it's going to be 10 years. And then the provisions will be unwind for the annual charge. And we have been given the cost of capital of the company as what? 8%. So the annual charge is going to be the 8% of the present value that we are going to be having. And that will be debiting into the income statement, and then we'll credit the provisions account in relation to that. So more or less like every year, how much are we going to be putting aside so that by the 10th year, we are going to be getting the $50 million so we can restore the place to, or the oil rig to an environmentally satisfactory condition when the oil is out. So let's get into the solution and then let's look at it. So let's get the preambles out. We are told in the question that the cost of the machine, so we tell the examiner we are working 3 zeros up, okay? So we're working 3 zeros up. So we need to get the initial cost of the asset, divide it into 2. Then the first thing we do is to get a present value of the environmental cost or present value of the provision. So EC here is not electoral commission, right? It's environmental cost. So present value of that is going to be 15,000, which is the 50 million, times 0.46. And so that gives us the provision. So 15,000 times 0.46, and that's going to be 6,900. So this is the present value of the environmental cost. It is this present value that I said we're going to be debiting property, plant, and equipment, and then we'll credit provisions. That is the initial recognition. So now if we want the initial cost of our oil platform, it's going to be the cost of the oil platform which is 30,000 plus the environmental cost, which is 6,900. So the total initial cost is now going to be 36,900. So this becomes the initial cost of the oil rig. Does it make sense? But remember, our provision is having 6,900 as well. So that is the initial cost. So on the date, that is 1st October 2015, this is what we do about the initial cost of the property. So the present value of the environmental cost discounted at the 8% will be 6,900. We debit property, plant, and equipment, and then we credit the provisions in relation to that. I see some of you guys joining as well. Give us a thumbs up on the video. That way we get more engagement and YouTube will be able to push the video to reach other people. So give us a thumbs up on the video. And in case you've not subscribed also, you make sure you subscribe to the channel because every single day I'll be coming your way 4:30 p.m. either lecturing or releasing a live video on that, something that will help you to pass your exams. So that's our initial recognition. So after the initial recognition, remember the examiner said, how should the above be treated in the financial statement for the year ended 30th September 2016? So that is exactly after 1 year. All right. So on subsequent measurements, we're going to be calculating depreciation. Okay. Depreciation. And that's going to be the total cost of 36,900 divided by 10. So depreciation 36,900 divided by 10, that will give us 3690. So this depreciation will be debited to the income statement and credited to the PPE. For that reason, we will say that the carrying value of our assets will be 36,900 minus 3690. And that's going to give us 33,12210. So this is now the balance for the asset when we go to the statement of financial position. Now, after that, remember what we're doing here is subsequent measurement, right? So after that, we need to unwind the provisions as well. We need to unwind the provision. So unwinding of the provision will give us the annual charge. So unwinding of the provision will be the present value, which is 6,900, multiplied by the cost of capital of the company. And we're giving that in the question as 8%. So what will we have? 8% of 6,900, that'll be 552. So the double entry for this 552 is to what? Debit the income statement, okay? And then you credit provisions. So you debit the income statement and then you credit the provisions in relation to that. So now, what is the carrying value or the carrying amount of the provisions that will go to the statement of financial position? So in the statement of financial position, our provisions will be the initial present value 3,600 plus the annual charge of 552, and that should be 4,152. $3,600, 552, 4,152. So this is the balance for the provisions in the statement of financial position. So this is how we deal with the workings for this question, right? But remember, we are not done. We are yet to extract the financial statement. The general entries I've done is not what the examiner said we should do. So we need to extract the financial statement. I think John Edu asked about this around last week. So let's look at it. So now in our income statement for the year ended, our depreciation 3690 will go there. Then our unwinding, that is the annual charge for the provision 552, will also be brought there in relation to that. Then in the statement of financial position, property, plant and equipment 33210, and then the provision 4152 in relation to that. So let's see how we extract our financial statement. Any question? Everybody following so far? If you have any questions, don't hesitate to put it in the chat. Maybe you don't understand a certain workings. I could go through it for you in relation to that. So let's look at the financial statements. So income statement is an extract, 30 sub, depreciation from workings, 3690, and then the provisions, the annual charge, 552. So this is what comes in the income statement. Then in the statement of financial position, you got to write these in full, okay? Under non-current assets, you're going to bring property, plant, and equipment, and that's going to be 33120. Okay, that's the property, plant, and equipment. Ebenezer said I should check the total provision again. 3600 plus 552. It's 4152. Ebenezer, you can check your workings as well. It's 4152. Let me present the statement of financial position on this side. Ebenezer, check your workings for the provisions. So statement of financial position. So non-current assets, you have property, plant, and equipment, 33120. Then we come to liabilities, and under that, non-current liability. Then under that, we bring the provisions. And that's 4152. Ebenezer, have you corrected yourself or have you seen it? We add the annual charge 552 to the present value. That's a double entry. We debit the income statement, credit the provision account. Ebenezer, are you okay now? Please, the depreciation is 3690, not 3600. Yes, that's what I've written here, 3690. Ebenezer, depreciation is 3690. That's what I've written there. That's what I have here, 3690. Everybody okay? So that is how we present the financial statement for the question, right? Okay. Then there is an II aspect of the question where the examiner said, describe how your answer would change if the government license did not require an environmental cleanup. So assuming there was no environmental cleanup, then there is no need for us to calculate any provisions. So in that case, our depreciation will be direct on the cost of 30,000. So it will be 30,000 over 10, and that's going to be 3,000. So it means that at the end of the first year, the carrying value of the asset will be $27,000. And that's what goes to the statement of financial position. Then in the income statement, the 3,000 will go there in relation to that. So assuming there was no environmental cost, there was no cleanup cost, then we won't calculate the provision, go through all the workings, the unwinding thing. All we will do is to calculate the depreciation on the cost of the oil platform, which is the 30,000 or $30 million. Then we get our answer in relation to that. So this is how we deal with a question like this. I hope everybody okay. Ebenezer, have you solved your issue with your depreciation and what I've written here? So plus the unwinding of 552 will give you 4152. Yeah, that is what we have for the provision here in the statement of financial position. Okay. All right, so I believe everybody is okay. And the second aspect, assuming we are not required to do any environmental cleanup, then the provision and the unwinding wouldn't have come in. And for that reason, we will just calculate the depreciation and then we go away in relation to that. All right, so let's go to our second question. And that's going to be on government grants, IAS 20. Now, just a few overview on government grants. We said that, or you must understand that government grants, it's a form of assistance, financial or non-financial, that a government gives to an entity for fulfilling certain conditions. So for instance, the government can say that, okay, if you go and establish, as part of the one district, one factory, if you go and establish a factory somewhere, then you will receive a grant of 10,000 cedis from the government, all right? You will receive a grant of 10,000 cedis from the $10,000, sorry, from the government in relation to that. Or better still, the government can say, okay, anybody that wants to establish a business somewhere around the northern region, we're going to assist you. We're going to provide you with some assistance. We are not going to give you anything financial, but we're going to be providing you with some assistance. So in that case, we are getting benefits, non-financial benefits. Now the question is, how do we account for the financial benefits as well as the non-financial benefits? The standard states that for the non-financial services, the entity must disclose it in the books. Okay, so for government assistance that we receive, the standard says we should what? Disclose in the notes to the financial statement. All right, so that is all. So the government will assist us, speak with the chief on our behalf so that we get the land and there will be no landguard issue coming inside. Government will also help us so that we can get the suppliers. So whatever assistance that the government is providing for us, we're not receiving any money. In that case, the standard requires that you do what? You disclose it in the financial statement. But the $10,000 that we received, the financial benefit, how do we account for that in relation to that? Now, the standard states that there are two ways we could account for the assistance that we've received in relation to that. Augustine, I see a comment. Enyonam, Jandu. Okay, I see a smile from you. Okay. Augustine A. Boatin said, I guess everyone is doing great. Good luck to you guys in the FR2 paper. I guess that's what we are doing now. Yeah, we're looking at accounting standards. It applies to corporate reporting students as well. So not only FR students, it applies to corporate reporting students as well. So when it comes to accounting for government grants, remember there are criteria, or there's a criteria that must be met. So recognition criteria. The first thing is that, as always, it's a condition, Okay, I see somebody. Xavier Ahido, an emoji from you. Okay. If you're watching, give us a thumbs up on the video, on the main video page. Give us a thumbs up on the video, and that way we get more engagement on the video, and YouTube will be able to push it to others, and it will help us to grow the channel together. Thank you very much for that. So what is the recognition criteria for government grants? You see, grant comes along with a condition. So the first recognition criteria is that it is probable that the entity will fulfill the condition, okay? It is probable that the entity will fulfill the condition. It is probable that the entity will fulfill the condition attached to the grant. Andrew Preko, I see you. Then, not only that, so what are the conditions? Let's say the government can say that, okay, if you establish a company in Wasa, something like that. If you establish a company in Wasa and you employ, maybe if you're employing 1,000 people, about 700 of them should come from that location, and you should produce and sell your output to manufacturers in Ghana here, so no export. So it is probable that the entity will fulfill the condition attached to the grant. Vincent Buster, I see you. You are welcome. Give us a thumbs up on the video. Give us a thumbs up on the video. That way we get more engagement. Second, the fact that the government has promised you to give you some money does not mean the money is actually going to come. So in as much as you are looking at you fulfilling the deal or the conditions attached to the grant, we have to also assess whether it is probable that the grant will actually be received. So it is probable that the grant will be received. It is probable that a grant will be received. Because you see, sometimes, now how can we determine that? We can determine that from precedents. Now, has the government promised someone or an entity and they didn't fulfill it? If there is any precedent like that, then it's possible that it could happen to us as well. All right. But if it is probable that, hey, this government is serious, and or maybe they've even wired the transfer even before the deal closed, then we recognize it in relation to that. So it is probable that we will fulfill the condition attached to the grant. Then it is probable that the grant will actually be received in relation to that. Enoch, I see you. You are welcome. So if yes, we can fulfill the deal or the conditions attached to the contract, and yes, it is probable that the grant will actually be received from the government, then we go to the recognition of the grant. Now, there are two ways that a grant can be recognized. I'll be talking to you about the two, and then I will tell you which one we're going to go for. The first one is that the grant is recognized as a deferred income, or it is used as a reduction to the cost of the assets. As a reduction to the cost of the assets. So these are the two ways the grants can be recognized. Recognizing the grant as a deferred income simply means that we're going to be debiting our cash. That is, if the government has wired the transfer already, or maybe receivables, if it is yet to be received. And then we'll credit the deferred income, grant deferred income, or grant deferred account. You could say that. Grant deferred account. So you debit your cash or your receivables if the money is not yet available. Then you credit your grant account because you are recognizing it as a deferred income. I'll come back to that in a moment. Then as a reduction to the asset, what do we mean by that? What do we mean by that? That means that we're going to be debiting our cash or receivables the same way, but this time around, we will credit the property, plant, and equipment that is bringing along the grant. So these are the two treatments available. However, the standard requires that grants should be recognized using the first approach, that is as a deferred income. So the initial recognition for grants will always be to debit your cash or your receivables, and then you credit the grant deferred account in relation to that. So that is always the initial recognition. That is always the initial recognition. Any questions, put it in the chat box for me. I'm going to be answering all of your questions. And then give us a thumbs up as well on the video so we get more engagement on the video. That way, YouTube will be able to push the video so we get more people to watch it in relation to that. Then so share as well if you know you have some colleagues who have to be here, who are not here. Share it with them so they come. So now that we look at the initial recognition, that is how the grant will be accounted for, on subsequent measurement, since we are going for the deferred income approach, the grant will now be amortized over the economic useful life of the contract, of the condition, or of the asset. So if it is 10 years, we are going to have an annual charge of the government grant, and that is going to be, so like let's say the example that I use, $10,000. So that's going to be $10,000, maybe let's say over 10. And so every year we're going to be charging 1,000. So what is the double entry for that 1,000? Simple. Grant is income. So we're going to be debiting the grant deferred account, okay? And then we'll now credit the income statement on the subsequent measurement, okay, with the annual charge. Remember, initially, we are crediting the grant account with the value of the grant. So every year, what we charge to the income statement will now be debited to the income account, sorry, to the grant deferred account. Then we'll be able to get the carrying amount of the grant, which will go to the statement of financial position. But you must understand what all happens as well when we go to the statement of financial position. When we go to the statement of financial position, yes, the grant will go to the liabilities, but we need to split it into the current liabilities and then the non-current liabilities. The annual grant chargeable will go to the current liabilities, then the balancing figure will go to the non-current liability. Now, so let me show you this. So liabilities, we have non-current liabilities and current liabilities. So let's say we've done 1 year. So now the carrying amount of our grant is 9,000. This 9,000 has to be splitted into current liabilities and the non-current liabilities. The annual charge, which is 1,000, will be the current liability here. And under current liability, we write deferred grant, 1,000 there. Then the balancing figure, which is going to be $8,000, will go to the non-current liabilities in relation to that. So this is how we deal with the issue about government grants. Any questions, please put it in the chat box. I'm reading all of your comments live, and so I'll be able to answer all of that. Now, note that grant is accounted for specifically this way so that in case there is a repayment, we will be able to just cross it out in relation to that. Just that, note that grant is accounted for using the deferred income approach, even though we can use it to reduce the cost of the assets. Take note of that very well. So what happens if the entity doesn't fulfill all the conditions? There are times when under the condition, the government may say that if you don't fulfill all, then you need to refund the grant that was given to you. Okay, so Xavier, he does said, explain the liability part again. All right. So what I'm saying is that, let's say the first year, we've charged a grant of $1,000 and the total grant we received was $10,000. So now the carrying amount of the grant is going to be $9,000. It's supposed to go to the statement of financial position under liabilities, but we need to split it into the current liabilities and then the non-current liabilities. And I am saying that the annual charge for the grant, what we will charge every year, will go to the current liability because that is the next one chargeable. Are you getting the idea? Then the balancing figure will go to the non-current liabilities. So in this case, my carrying amount of the grant is $9,000. Make sense? However, the annual chargeable is $1,000. So that annual chargeable of $1,000 will go to the current liabilities. Then when I take that 1,000 from the carrying amount 9,000, I'll be left with 8,000, and that will go to the non-current liabilities. So Xavier, are you okay with the liability part? Okay. So Xavier said he's okay on that. That's fine. So I was talking about the refund before Xavier came with his question. So if you have any questions, you know what to do. Put it in the chat box. I'm going to be answering all of your questions for you. So like I was saying, there are times when attached to the contract, attached to the condition, the government will require that if the entity refuses to fulfill all the conditions, then the entity has to refund all the grants. So all the 10,000 grants we receive, we need to refund it. There are times where the government could say that, okay, if you don't fulfill all the conditions, you should refund only part of the grant. So look at how it's going to be. I'm just going to bring up some things to help you to understand it. Okay. So let's say still we go for the $10,000. That is the grant we had. So let's say after 4 years, we realize that we can't fulfill the grant. So let's say that still we have the 10,000 there, but after 4 years, now the carrying amount of our grant is how much? $6,000. Augustine said, are there practical reasons why the government issue grants to corporate entities? Yes, it's a way to motivate organizations or companies to establish or make investment decisions by opening up companies in locations that they wouldn't have opened it up in relation to that, so that especially if it is about manufacturing, food processing, or agro processing, so that the farmers there growing the crops will no longer think about transporting the crops to the big city to sell, so that they can sell it to that company there and will be able to provide relief for the farmers there. Two, it could be an economic reason so that more employment will be created in that place or in that location for the people. So once there is employment, there will be reduction in social vices as well in relation to that. So that is another reason why government will give grants to the entities in relation to that. So as a relief to the farmers there, to provide employment to the people, to reduce social vices, and also to enhance economic growth. Because at the end of the day, if more people, there are jobs, people are working, government will be able to charge tax, pay PAYE, and that will be a source of revenue to the government in relation to that. And that way, government also is able to now focus on other aspects of the economy and not to be thinking really about job creation, the farmers, and all of that. So these are some of the practical reasons why government will give grants to organizations. Remember, tax waiver is also a form of grants that government gives. So there are companies currently in Ghana operating in various industries who are under tax waiver, and some are like 23 million Ghana cedis and like huge amounts like that. So that is also a form of grant. So the tax that you're supposed to pay to the government, it's giving back to you again for the same reason. So you put it back into the business, it motivates you to go into that place, go into that industry, and establish that business in relation to that. So Augustine, I believe you're good. So let's look at the refund issue. So let's say after 4 years, so we've been in existence for 4 years about this grant. And so for the 4 years, we've allocated 4,000. So now the carrying amount of our grant is $6,000. Right, Pawili, I see you. So let's say that condition one, we are supposed to refund all the money for non-fulfillment. So full refund, right? That's the first one. And then second one is going to be a partial refund. So if we are doing a full refund, after the 4 years, the grant account has $6,000 in there. But remember, we went for $10,000. So what's the double entry there? We're going to be crediting our cash or bank to pay the $10,000 back to the government. Then we debit the grant account, deferred grant account, $6,000 to remove the 6,000 that is there. Okay. Then the balancing figure will be expense in the income statement. That's 4,000. So this is how we deal with a double entry if after a number of years, after receiving the grant, we are not able to fulfill all the conditions and it requires that we need to make a full refund. What if we are required to make a partial, okay, Augustine said thanks, you're welcome. So what if we are required to make a partial refund? So if we are making a partial refund, that one, chances are maybe what we have in our grant account will be enough. For that reason, all we do is that we'll credit our cash with the $6,000. We'll do that well. So we credit our cash book with the $6,000. Makes sense? And then we'll debit the deferred grant account with the $6,000. That's all. Making a partial payment. Making a partial payment. Now, as part of the partial payment, assuming the amount in the deferred grant account is not enough, then the balancing figure will still go to the income statement. Okay, because at the end of the day, if what we are paying is more than what is in our grant account, then the balancing figure goes to the income statement in relation to that. So this is how basically we deal with IAS 20 government grants. And the reason why I'm taking you through it, it's because we have a question here that we will be looking at in relation to how grant is supposed to be treated for the organization. So if you have any questions, please put it in the chat box, put it in the comment box. And give us a thumbs up on the video. In case you've not given us a thumbs up, give us a thumbs up on the main video page. That way we get more engagement, and YouTube is able to now push the video well to others so they can watch. And you can also share it with your friends, your colleagues on your WhatsApp platforms, your Telegram platforms, your Facebook groups, so we can reach as many people as possible. Okay, so now that we've had these principles, we've understood how grants should be accounted for as a deferred income and not being recognized based on the refund that we're going to be making and all of that. Let's look at an example of how we can deal with the grants. I see a question from Pawili saying, in Octomaklo, all right, I see you. Pawili said, what is depreciation in relation to taxation? When you say depreciation in relation to taxation, what do you mean? In taxation, we don't consider depreciation. So any annual depreciation by the entity is added back to the net profit in the determination of the chargeable income of the entity. And then capital allowance will be allowed, because in taxation, depreciation is not considered. It's capital allowance that is considered. Okay, so let's look at the question. Pawili, I believe you understand. If you don't understand, you can maybe clarify your question better for me in relation to that. Okay, so I see another question from Pawele. He says, what is the meaning of depreciation? The depreciation is simply the allocation of the cost of the asset over the economic useful life, or the charge of the annual usage of an asset to the profit of the organization. So you buy an asset and you use it for your business, and you are allocating, or you use it for the year. So at the end of the year, the usage of the asset must be also charged to the income statement. So the usage of the asset you are charging to the income statement is what we refer to as depreciation. So let's look at the question we have here. It's on government grants for 5 marks. Let's see how it goes. So you can take a screenshot of it. So let's see. Go up a little. Okay. So let's see. On April 2013, Skeptic received a government grant of $80 million towards the purchase of new plants with a gross cost of $64 million. So the cost of the asset is $64 million, and the government grant was $8 million. The plant has an estimated economic useful life of 10 years and is depreciated on a straight line basis. One of the terms of the grant is that the sale of the plant before 31st March 2017 would trigger a repayment in a sliding scale as follows. Listen to this carefully. The company buys the asset on 1st April 2013, and the condition, or one of the terms of the grant, was that should the entity sell the grant on the or before 31st March 2017, it will trigger a repayment on a sliding scale as follows in relation to that. Then I see a comment from Yonila Nako. Okay. How do we account for CPI linked leases under IFRS 16? When you say CPI linked leases, what is a CPI linked leases? What's the full meaning of CPI? Yonila, provide me the full of that and let me see if I can, what you meant by that. So accordingly, the directors proposed to credit the statement of profit or loss $2 million, that is 8 million of 25%, being the amount of the grant they believe has been earned in the year to 31st March 2014. Skeptic account for government grant as a separate item on deferred credits in its statement of financial position. Skeptic has no intention of selling the plant before the end of its economic useful life. So this is the question we have, and the requirement is how should Skeptic account for the above transaction in the financial statement for the year ended 31st March 2014. So remember the asset was acquired. Let me pick my highlighter up. So the date or the beginning of the year is 1st April 2013, and the end of the year is 31st March 2014. So that is exactly 1 year period. Now, the policy is that should the company sell the machine before 31st March 2017, it will trigger a repayment. But the good news we are told is this, that skeptic has no intention of selling the asset. Now, even if they should have an intention to sell the asset, it will still be accounted for as a deferred grant. For that reason, the director's recognition of $2 million as the grant for the year ended 31st March 2014 is wrong. We need to charge the grant over a period of what? 10 years. So every year it's going to be $800,000. That is 8 million over 10, and that is going to be $800,000 in relation to that. So that is how we're going to be charging the grant. So the grant for the year ended 31st March 2014 is 8 million over 10, and that is going to be 0.8 million or $800,000 in relation to that. So the grant is not accounted for based on whether the entity has an objective of selling the asset or not selling the asset. They will just account for the grant as a deferred income in relation to that. And in the question, we are told that the entity has no intention of selling the assets before the end of its economic useful life, which means that that condition will be fulfilled. So we need to continue in relation to that. Okay, so I think Yonila said, how do we account for consumer price index leases under IFRS 16? Okay, now, I don't know the context in which you are asking the question, but I need to see the context to be able to answer you well. But this is what you got to understand. Under IFRS 16, when we are determining the lease liability, there are a couple of components that goes into the determination of lease liabilities, okay? And one of the components is the annual payments that the lessee has to make. Another component is the issue about consumer price index, assuming there is going to be changes or variation in the leases that we are going to be paying over the years. So whatever changes that is going to be will also be included in the determination of the lease liability. Are you getting the concept? Then any purchase option that we're going to be having will be added to the lease liability or will be included in the lease liability. Then any penalty for termination of the contract before the end of the lease term will also be considered in relation to that. So Yonila, if I get your question well, the issue about price index is actually included in the determination of the lease liability. Remember, we debit right of use, credit lease liability. So that lease liability, the price index will be included if there is going to be that variation in the lease payment in relation to that. So if your question is in that line, that is the answer. But if it is not in that line also, you can give me a clarification better, then I would provide you with some understanding on that. Okay, so let's go and see how we can solve this question now. So let's get some preambles up real quick. The grant we received was, we working 3 zeros up. Let me rewrite this. Maybe let me share my. So 3 zeros up. So the grant was 8 million. That's $8,000. Then we go to the issue in relation to the economic useful life of the asset. That's 10 years. Then we are told the cost of the asset is 64 million. That's 64,000 in relation to that. Yeah, I think that is all. So And remember, the year is very important. 1st April 2013. And then the reporting date, RD, is 31st March 2014. So it's exactly 1 year. Okay. So what do? We calculate the depreciation, and that's going to be 64,000 over 10, and that's going to be 6,400. So that will go to the income statement for the year ended 31st March 2014. So let's get the carrying value of the property, plant, and equipment. That's 64,000 minus 6,400. So 64,000 minus 6,400. That's going to be 57,600. Yonila Nako, did I answer your question the way you wanted it to be answered? Let me know in the chat box. Okay. So this is the carrying value of the machine that goes into the property, plant, and equipment in the statement of financial position. Then the grant would also be amortized over the period. So grant charge, we can say annual charge, that's going to be 8,000 over 10. That's going to be 800. And so once we have that, we now go to the carrying amount of the grant. And that's going to be 8,000 minus 800. And that's going to be 7,200. Good. So that also goes to the statement of financial position under liabilities. But remember, we said that has to be splitted into two. So the non-current liability component, then the liability component. Now the non-current liability component or the current liability component is going to be the annual charge of 800. Then the non-current liability will be the 7,200 minus 800. That will be 6,400. So this is how the statement of financial position will be dealt with in relation to that. So in our income statement, what do we bring? We bring the depreciation for the year as an expenses, the grant charge for the year as an income. Then in the statement of financial position, the carrying value of the property, plant, and equipment will go under non-current assets. Then under liabilities, non-current liability, we bring deferred grant, 6,400. And then under current liabilities, deferred grant, 800. So this is how we do the workings for this question on the grant. So I see some comments there. Let me look at it. I really said, can you give a practical example in relation to depreciation in real estate? Now, when you say in relation to depreciation in real estate, are we talking about a real estate company in relation to that? If you're talking about a real estate company, then certainly they are going to be charging depreciation on whatever assets that they are using. All right? They are going to be charging depreciation on whatever assets that they are using in relation to that. Now, that real estate company may also own some properties, whether it is renting it out or it is managing it. And those will be either recognized as investments or as inventories. If there are buildings we are selling, then there will be inventories in our books as an inventory, sorry, as a real estate company. But the depreciation aspect will come in for the assets we are using to run the business and any equipment that we are using, vehicles we are using, depreciation will come there in relation to that. Yonila said, when raising the right of use of assets, we add all our lease payments over the lease term and apply the annual escalation rate for CPA. Do we use an estimated CPI rate? Okay. So I think I understand now where your question is coming from. Now, the cost price index will be given to us in the question in relation to that, right? So whatever index that we are supposed to use will be given to us. So either it will be implicit in that particular lease, or we will use the general CPI rate to be able to use it in relation to that. So it is either it is implicit in the lease, just like how the borrowing cost or the interest rate implicit in the lease may be given, or we will use a general borrowing rate. So the same thing applies to the CPI rate in relation to that. So Yonila, it depends on the question. It may be given in the question as implicit in the lease, or we may be using an estimated CPI rate to be able to work on our computation in relation to that. Okay. So let's see how we put the pieces together in the preparation of our final account. I'm going to put this 57,600 here, so that, and then the depreciation of 6,400 here, so that when I'm preparing my financial statement, it will be simple for me. Any other questions you have, please put it in the chat box for me, okay? I'm going to be replying to all your comments. So the income statement, and this is going to be an extract. Okay, so Yonila said thanks, you're welcome. So in the income statement, we are going to be bringing two things: the grant charge for the year, or we could say grant received, that's 800. And then the depreciation charge for the year, that is 6,400. That's an expenses, so we put that in brackets. Okay, Pawili also said thanks, you're welcome. So in our income statement, the grant received is an income, because the double entry is we debit the deferred grant account and credit the income statement. So that is an income. But the depreciation, we're going to be debiting the income statement, so it's an expenses. That's why we put it in brackets. And then we credit the property, plant, and equipment, right? So that's the income statement. So let's go to the statement of financial position. I'm going to do that on the left side. So let me just write these figures here for me. 6,400, and then 800, and then 57,600. So statement of financial position. So under non-current assets, property, plant, and equipment, and we got a figure of 57,600, right? Then we come to the liabilities, and under that, we're going to have non-current liability, and we'll have deferred grants. Write this in full. 6,400, And then under current liability, same deferred grant, and that will be 800. So that is how we present the statement of financial position and then the income statement for the year ended 31st March 2014 in relation to that. So that is how we deal with government grants as well. Any other questions? Put them in the chat box for me. Okay. So we've looked at IAS 16 and we looked at the issue in relation to government grants and its treatment as well in relation to that. So let's look at another question. Okay, let's see a comment from Yonila. Yonila said, what is the difference between OCI and P&L? Okay. So Yonila, the whole financial statement or the statement as a whole is called profit or loss and under comprehensive income. The profit or loss aspect, it's about the core activities of the organization, okay? Then the other non-core activities of the organization usually is what comes in the OCI in relation to that. So for instance, if you revalue an asset and there is a revalue gain or revaluation gain, we don't take it to the P&L account, rather we take it to the other comprehensive income account because that is another income that is coming in, but not really from the core operations of the organization. So in the OCI, other issues like revaluation gain, deferred tax on revaluation, issues in relation to hedging profit or gain or losses, those are the things that comes in the OCI. Then the things that are traditional to the organizations, like grants received, like depreciation, like income tax, like office expenses, those kind of things comes to the profit or loss account in relation to that. So Yonila, I believe you are okay about the distinction of the two. Willie said, what taxation book do you have available? The taxation book I have available, it's my book on taxation, this one. This is my book on taxation. That's what we have available currently in relation to that. So that's my book on taxation. You can get it on Amazon if you want, or you can also get a copy here in Ghana as well. Then Andrew Opoku Beko said, please, with the PPE question, where did we obtain 3,600 from? Okay, so let me refer to the question. We obtained did we even get anything like 3,600? Let me just cross check. Did a screenshot of all of them. things. Let me share my screen with you. Okay, so the 3,600 was coming from the present value of the 15 million. Okay, Andrews, it was the present value of the 50 million, which is this figure. This is where we got the well. Oh, okay, that means, whoa. So this provision figure is wrong. Okay, so Andrews, thank you for that. It's not supposed to be 3,600. It's supposed to be this figure, 6,900 plus the 552. I did a screenshot of all of the work. So thank you for that. It's supposed to be not 3,600, but 6,900 plus the 552. So it means this figure here is supposed to change. So it should be 6,900 plus 552. So Andrews, thank you. You can correct that. Then Johnny Do said, sir, please, when lease payments are made every 6 months in advance, how do you determine the non-current liability and the current liability as well as payments in arrears? Okay. So in order to do that, I need to give an illustration and then show you how we do the treatment. So Andrews, thank you for the correction. So let's see. I need to go back, stop sharing my screen. And let us share a whiteboard. Okay, Andrews, you are welcome. Thank you for the correction. That was an error. I don't know, many of you did not see that. So according to IFRS 16 leases, if we are making payments in advance for every 6 months, the pro forma, you're going to bring the year, you bring the balance brought forward, then you bring the lease payments, then you get a capital balance, then you bring your finance cost, then you get your carry forward in relation to that. So once you are making the payment like every 6 months like that, it depends. But your question is, how do you get a current liability and non-current liability? So I'm going to just do an illustration and then show you that. The simple language is that the next lease payable becomes the current liability. And then when we deduct that from the carry forward, the balance becomes the non-current liabilities. So let's say, for instance, period 1, you do your brought forward, you less your leases, you get your capital balance, you apply the interest on that, and then you add it up and you get your carry forward. This carry forward here has to be splitted into the current liability and then the non-current liability. So the next installment payable, okay, the next installment payable is the current liability. So lease payment is the current liability. Then the carry forward minus the lease payment becomes the non-current liabilities. So, John Edu, has this answered your question? Is that what you're looking for? Augustine said, does grant form part of the capital structure of a corporate entity? Does grant form part of the capital structure of a corporate entity? It's part of the liabilities. So if you want, yeah, we could say it's part of capital employed in relation to that, but that doesn't mean it's really part of the capital structure of the organization, but it's part of the liabilities. And so definitely it will be included in capital employed. So there are times when you are doing interpretation of financial statements, the question may limit you to remove the grant effect in the determination of the capital employed in relation to that, because typically it's not something that will stand for a long time. It is going to be amortized over the years in relation to that. So on one side, we could say, yes, it forms part of the capital structure. On another side, we could say, because it will be spread over a given period, it's not supposed to form part in that case. John Edu, are you okay? How will he said, how can okay, so John is saying, say, assuming the payment is done every 6 months, it's going to be the same thing, okay? If the payment is done every 6 months, it means for every year, you will do for 2 periods. So what is going to happen is that the annual rates, the annual interest rate implicit on the lease will be divided into 2, okay? So that the period 1, period 2, this same figure will be brought here. The monthly payment will go off. You get your capital balance, the interest will be brought, then the closing balance will be brought. Are you getting the idea? Now, even though the lease payment is made every 6 months, when we are presenting in the statement of financial position, example, 1st January for the first lease payment and second on 1st June. Yes, that's what I'm saying. So if the payment is made half year, it doesn't matter. We still have to do our workings. And remember, this finance cost will be added into 2, and that will be for the finance cost that will go to the income statement for the year ended under consideration. Okay, we added 2 interest. But I'm saying if we go to the statement of financial position, what you must understand is that because the lease, even though it's payable in 2 installments, the 2 will still be paid within a year. So the 2 lease payable will be as a current liabilities. Then when we deduct that from the carry forward figure, what we get go to the non-current liabilities. So if we are paying the lease like every 6 months, that's how we go about it. That's how we go about it. So let me know if you understand. Pawili said, how can small and medium businesses benefit from the government stimulus plan in relation to the economy? Thanks. And small businesses can benefit by applying, and there are conditions for the grant or from the stimulus. It should be an entity that is duly registered. It should be an entity that is paying its tax. So you have your tax documents and all of that there in relation to that. So John Edu said, okay, thanks. So Pawili, the basic requirement is that the business should be duly registered and the business should be like a taxpayer like that. And I think they've launched a portal that you can apply on. And when you are applying, there are other requirements that you would see whether you qualify and fit into the category. I don't have much information about the stimulus plan for businesses as a whole. in relation to that. The basic thing is, like I said, it should be a duly registered institution. And if you are supposed to belong to any regulatory or association, you should be recognized by those regulators and those associations before you can apply for those grants. I think Ghana's own is 600 million Ghana cedis also. That is it about that. So John Edu said, okay, thanks. You're welcome. So let's look at a couple of other questions. Any questions, please put it in the chat box for me. Okay, Pa Willie said thanks. You're welcome. Now, for those of you, somebody was asking about tax book. I don't know if it is Pa Willie. Like I said, like there is a tax book now, but we are releasing a revised one also very soon. So probably you can wait a while. I don't know how fast you want it, but you can also wait a while to get the new one, revised one that will be coming out early February, sorry, July in relation to that. So this is the new one coming up very soon. So let's look at some other questions here, still in relation to other standards together here in that case. So you can take a screenshot as we go through these final deductions. It says, for each of the above properties, briefly state how it will be treated in the financial statement of Victoria for the year ended 31st December year 8, identifying any impact on profit or loss. Identifying any impact on profit or loss. So let's look at property 1. Property 1 was acquired on 1st January year 1. It had a cost of $1 million, comprising $500,000 for the land and $500,000 for the building. The buildings have a useful life of 40 years. Victoria uses this property as the head office. Okay, so how do we account for property 1? Property 1 will be accounted for in accordance with IAS 16, isn't it? Because they are using the property as their head office. But remember, the total cost of the property is $1 million, which comprises of a land, which is 500,000, and then the buildings, 500,000. You know, land is not depreciated. So what we do is that we will depreciate the building over a 40 years period. Remember, the year ended we are considering here is also 8 years, right? So we do 500,000 over 40 times 8. Then we'll get a total depreciation, and then we'll now be able to get the carrying amount of the building. Once we know the carrying amount of the building, we add it back to the 500,000, that is the land, then we'll now get the carrying amount for the land and building. That will go to the statement of financial position. But take note that for the year 8, it is the depreciation for year 8 that will come into year 8 income statement in relation to that. John Edu said, please, the Amazon, I don't know much about it. Do I have to Google or I can download or the Play Store in order to access your books? Oh, okay. Use, just trying to see. You can download the Amazon Kindle app. It's on the Play Store or the App Store whichever device you are on, and you can download it in relation to that. So when you download the Kindle, Amazon Kindle app, then you can just, in the search bar, you can type Nhyira Premium. Once you type Nhyira Premium in the search bar, you'll be able to get the books there. Or better still, you can just Google Amazon. Then when you go to Amazon, you just type in the search bar Nhyira Premium, and my books will come up in relation to that. So that is how you can access them. So that's how we deal with the property one. Now let's go to the property two. Property two was acquired many years ago for $1.5 million for its investment potential. Listen carefully. This one, it says the property was acquired because of what? Its investment potential. On 31st December year 7, it had a fair value of 2.3 million. By 31st December year 8, its fair value had risen to 2.7 million. The property has a useful life of 40 years. All right, you are welcome, John. So if you look at property two, it was acquired at $1.5 million, and it was acquired because of its investment potential, which means that property two must be accounted for in accordance with IAS 40, investment property. I hope you are getting the concept. It must be accounted for in accordance with IAS 40, investment property. Now, investment properties are not depreciated. So even though the examiner has given us the economic useful life, we don't depreciate investment properties because investment properties are carried at their fair value. So if we check, we realize that we are told in year 7, the value had risen to 2.3, which means 2.3 from the 1.7, there is going to be some revaluation gain. Are you getting it? So 2.3 minus 1.5, that could be 8, I guess. Yep. 2.3, 1.5. No 0.8 in relation to that. So that is a revaluation fair value gain. Okay. Then for the year 2008, which is under consideration, the value now is 2.7. So there is also another gain here of around 0.4. Okay, around 0.4 in relation to that. So that is again. So now when we go to the statement of financial position, December year 8, this property will be carried at 2.7. Then in our income statement, we will bring a fair value gain of what? $400,000 or 0.4 million in relation to that. So that is how we account for the property 2. Then look at the property 3. Property 3 was acquired on 30th June year 2 for $2 million for its investment potential. Again, they are using the word investment potential here. So meaning it should be accounted for in accordance with what? IAS 40. But let's build it up. The directors believe that the fair value of this property was $3 million on 31st December year 7 and $35 million on 31st December year 8. However, due to the specialized nature of the property, these figures cannot be corroborated. Listen to this carefully. Due to the specialized nature of this property, these figures cannot be corroborated. The economic useful life of the property is 50 years. So if you look at this, this is an investment property bought at $2 million. Now, the directors themselves said that, oh, we believe that the value of the property is $3 million in year 7 and now $3.5 million in year 8. But this property is a specialized property. Because it's a specialized property, these values that the directors have placed on the property cannot be corroborated, cannot be confirmed, meaning that there is no ready market available for this product, or sorry, for this property because of its specialized nature. For that reason, this property will be accounted for at the initial cost at which it was bought, the $2 million. Does it make sense? Now, I want you to make sure you get a difference between these three properties we are dealing with. So the property 3 is an investment property and should be carried at a fair value. But because of its specialized nature and the value that directors are placing on the property cannot be confirmed, there is no ready market available, then we still have to carry it at its cost in relation to that. So if anything in this case, the entity will find out whether the property has wear or tear, and they can use the cost module to be able to amortize or charge any impairment loss on it in relation to that. So the revaluation gain or fair value gain here will not work in relation to that. So this is how we account for these properties in that case. So any questions for me, please? Any questions? Any questions again? Any questions? Okay. So I'll be concluding around here today, and we'll come back tomorrow, same time, 4:30 p.m. and continue with our discussion. Remember, this is the Executive Revision Masterclass, a session I'm holding with you guys to explain some key things in the syllabus on the key topics in the subject, so that you'll be able to prepare well and go to the exam hall and understand the concept well in relation to that. So John Edu, Kledos, Ebenezer, Chachu, Enyonam, Yonila, Pawili, Enoch, Augustine, and all of you guys, thank you very much for joining the stream. Okay, I see a comment from Pawili. He said, what will be the consequences of withdrawing from a 1-year government bond from a bank after just 6 months, considering the depreciation of the interest rate? What will be the consequences of withdrawing from a 1-year government bond from a bank after just 6 months, considering the depreciation of the interest rate? The consequences is that since the bond is not due to be redeemed, it will be discounted. So it will be discounted for you. So if, for instance, you will redeem it at, say, 10,000 Ghana cedis, because after 6 months, you are now withdrawing and you are no longer going to the fund, it will be discounted and you may not get your 10,000 cedis in relation to that. You may get something below the 10,000 cedis in relation to that. Yes, Samuel Kwasin, how are you doing? It's been a while since I heard from you. I believe you are doing well and you are studying. Okay. John Edu said, God bless you, sir. Amen. God bless you too. Pawili said, will I lose the principal? No, you will, because it is not due to be redeemed, you will not get the entire interest, but you will get your principal. Definitely you will get your principal, but it is the interest that you will not get all in relation to that. But it depends on also how the loan is structured. There are some loans, if you withdraw from before the redemption, you may lose up to even a portion of the principal. But to say losing all the principal, no, you may lose the interest on the loan. And then depending on how the loan is structured, you may lose a portion of the principal, but not the entire principal in relation to that. Kletos, God bless you, say amen. I will get in touch by close of the week. Awesome, Kletos. I believe you are doing well in relation to that. Samuel said, I just joined. I will surely watch the playback. Okay, Samuel, that'll be fine. We discussed a couple of accounting standards, IAS 16, IAS 20, and then we solved some questions, and some interesting questions were also popping up from Pawili, John, Yonila, Augustine, and co. And so I guess watching the playback will be helpful for you as well in relation to that. So thank you guys for taking time to watch the stream. I'm very much excited, and it's always a privilege to come your way every day to assist you, provide you with some guideline and answer your questions for you in relation to that. So continue to stay connected. Make sure you share the channel with your friends, colleagues on WhatsApp and all of the platforms that you can. Let's get as to many people as possible in this period of school closure, that people are still studying, stuck in their houses, their homes, and that we're going to be looking at that in relation to that. So continue sharing, and then we will be looking at it in that case. Yonila said, when are you doing IFRS 9? That is financial instrument. Okay, one of these days we will look at that, Yonila, but you can check the channel playlist. I have the standards already available on my channel playlist. So you can check the channel page, the playlist titled Accounting Standard Series. Yonila, check that playlist, Accounting Standard Series. As of today, we have 48 videos in that playlist, and I have the videos on almost all the standards. IFRS 9, financial instruments, certainly I have some videos on that. So Yonila, you can check that playlist, Accounting Standard Series. I have some videos on that, but I will also be coming on live stream to discuss something about it, and then also answer any questions you guys may be having. Possibly tomorrow, certainly we can continue with the discussion on that. Okay, so by Yonila, in the meantime, check the playlist and then you can watch the videos there. Then after that, if you have any questions on the live stream, you can hit me with it, then I will answer for you in relation to that. Okay, Xavier Ahido said, thank you, sir. You're welcome, Xavier. Okay, Yonila Nako said, thank you, sir, and God bless you. Amen, Yonila, God bless you too. All right, so thank you very much for joining the stream. As always, I'll see you same time tomorrow, 4:30 p.m. or 16:30 GMT, as we continue with our discussion. As always, remember to still keep studying, still keep taking care of yourself. And remember, coronavirus is still here. So when you go out, make sure you wear your face masks or your nose masks or whatever masks we call it. And make sure you sanitize your hand, wash your hand regularly, keep 6 feet or 3 feet, whatever they're saying, social distancing. Make sure that you take care of yourself, and all the best. I'll see you same time tomorrow. Bye-bye.